So moving on to the next slide, you'll see that we're just going to go over a few basics of central banking, fractional reserve banking, and for the latter part of the presentation, we're going to go over the Federal Reserve and basically its history to where it's now.
Okay, so what are central banks? So many developed countries have central banks, which are basically government bodies that are in charge of monetary policy. And this allows them to control money supply and economic growth. And if you remember, like I think a few weeks back, I remember I talked about in my political econ passion project that monetary policy can be contractionary or expansionary, and central banks can also regulate the banking system. So some of their goals are to maintain price stability in the economy, which number two controls inflation. And the Fed usually aims for a 2% inflation rate. And three, decrease employment, which helps boost the economy. And these are just, here is just a list of central banks in the world. The Fed, which is the most influential central bank in the world. The EU, which unlike the Fed, they try to keep their inflation rate below 2%. The Bank of England, the Hong Kong Monetary Authority, and the Swiss National Bank, which they have a higher interest in keeping inflation down since they're more dependent on exports.
So fractional reserve banking is the concept of when you go to a bank, not all of the money is going to be they're not going to have all of the mint readily available for you. So essentially, when you go to a bank, they're only going to have a fraction of all of the deposits that they have on hand. So when you go to a bank, and imagine everyone goes to a bank and everyone wanted to withdraw all of their deposits that they've ever made into that bank, then the bank wouldn't be able to do that because under fractional reserve banking, they're only going to have a little bit of the money on hand ready to ready to withdraw. So with this in mind, you got to know that most banks only have around 10% of the deposit on hand, and the rest on hand, the money that's on hand is called reserves, and the rest of the money is either loaned out to another bank or given out to a consumer as a loan. Okay, so this is a visualization of the actual fractional reserve banking in action. As you can see, Bank A has received money from the Federal Reserve, so they're going to deposit $1,000 into that one bank. Let's just say that bank is Bank A, and then that Bank A, they're going to keep $100 as a reserve. And a reserve is the money that people can readily withdraw from their accounts and have on hand as cash, and they're going to loan out 900. But even though they don't have the $900 in cash at the bank, they're still going to say that they have all $1,000. So technically, you wouldn't be able to withdraw all of the money, but you can withdraw 100, but you still have all $1,000. So then let's just say they loan all $900 to Bank B, and Bank B also does the same thing, where they keep only 10% of this as reserve. So the 10% cap is $90, and they then loan out the rest of the $810, which is the other 90%, and then that goes to Bank C, which then repeats this process over and over again.
All right, so now we'll get into the Central Bank of the United States, which serves as arguably one of the most powerful institutions in the nation, if not the world, since it holds so much influence over the economy. Now, moving on, before 1913, financial panics were common occurrences because investors were unsure of the safeties of their bank deposits. So imagine in modern times, you wanted to get like a haircut from Pleasanton Barbershop, which only takes cash. You go to the nearest ATM machine, but they don't have any money. That is essentially what happened in the past. And these private financiers, such as JP Morgan, who bailed out the federal government in 1895, often provided the lines of credit to provide stability in the financial sector. Following the Panic of 1907, which served as the catalyst for the Fed, was the 1913 Federal Reserve Act, signed into law by President Woodrow Wilson. Essentially, this allowed the 12 Federal Reserve banks the ability to print money to ensure economic stability. By the way, if any of you guys have TikTok, there's this account called Planet Money, which made a 3-part series about the history of the Federal Reserve in a super creative way. You can also read more about it through my article on StreetFints.
Okay. So there are 3 key entities, and these are their functions. So the first is 12 regional banks. These are found across the United States. They supervise financial institutions, facilitate government policy, and provide payment services. The second is the Board of Governors. They guide the operation of the Fed. They also analyze domestic and international economic developments, and it is made out of 7 members and a chair, which is appointed every 4 years. And third, there's the Federal Open Market Committee. They review economic and financial conditions and then are responsible for monetary policy decisions, including maximizing employment, stabilizing prices, and moderating long-term interest rates. And the first 2 out of those 3 are known as the Fed's dual mandate.
Also, it's important to note that the Fed needs to be independent of politics. Monetary policy and all that is too important and technical to be determined by politicians. So a central bank should also be wholly divested of any commercial banking interests. Now, moving on, as we've mentioned previously, the Fed has its goals of price stability and maximum sustainable employment. Can anybody tell me what that term was again of the 2 goals of price stability and maximum employment? You can just leave it in the chat. It starts with the letter D. All right, if nobody knows what it is, it's called the dual mandate. That's an important key term to know about the Fed. It'll also be covered in macroeconomics, I believe. And the other 3 key goals of the Fed is really to just smooth the ups and downs of the economy. This is also done through monetary policy, which we'll get to in a bit. The second one is to regulate commercial banks. We talked about how the Fed performs bank stress tests, which is an analysis to determine whether a bank has enough capital to withstand an economic or financial crisis. And the third one is to respond to economic crisis. So in recent times, the Fed actually cut the target interest rate to 0 in response to the recent economic slowdown. Some wonder if the Fed was all out of ammo in an attempt to spark economic growth. But no matter how bad the economy suffers as it deals with COVID-19, the Fed can always increase how much money it is lending to the economy to support it. But it has to venture beyond its normal activities to do so. This doesn't mean that the Fed can by itself get the economy out of this recession. For that, it would probably have to cure COVID-19 itself. Obviously, the Fed cannot do that, nor can the Fed reopen businesses. But what they can do is to take steps to help these businesses mitigate financial losses and keep borrowing money through IOUs so that they can stay alive until the economy does reopen. So back in March or April, the Fed actually set up 9 new lending facilities to get money to different parts of the economy in partnership with the US Treasury Department. This has been a much bigger, much faster response than the Fed during the financial crisis of 2008. But we'll get into more detail about the specific actions the Fed has taken in response to the pandemic, like quantitative easing. But you can also listen to Planet Money's podcast on this subject, which I'll link below.
So now I'm going to be talking about monetary policy, which is broadly defined as the actions undertaken by a nation's central bank to control the money supply and achieve its economic goals. So you may be wondering what the money supply is, and that's basically all the currency and other liquid instruments in a country's economy on the date measured. The money supply roughly equals both cash and deposits that can be almost used as easily as cash, or in other words, the amount of money available in an economy. So now there are 2 types of monetary policy central bank can pursue: expansionary and contractionary. But it really helps to think of these 2 words in terms of a balloon. So let's say our economy is a small, tiny balloon, and we want to inflate it and grow our economy or grow our balloon. So we pump air into it, and that is basically taking this expansionary monetary policy. And on the flip side, let's say we have a balloon that's too big, and let's say our economy rampant inflation or something along those lines, and we want to decelerate the growth or shrink the economy in a way to combat inflation. That is contractionary monetary policy. So for monetary policy, what central banks would do is that they would actually increase the money supply to boost growth by multiple avenues, but the three avenues I'll mention are purchasing bonds in the open market, lowering interest rates, and the reason that works is because when you lower interest rates, more people can borrow at a cheaper rate, meaning more money is flowing in an economy, more purchases being made, more consumption, thereby driving growth. And finally, lowering bank reserve requirements, which I'll get into more depth later. But as Matt and Gordon both mentioned, lowering bank reserve requirements allows pretty much more money to be flowing in an economy. As for contractionary monetary policy, central banks would essentially decrease the money supply to slow down growth, which is basically the main tool that they have in fighting inflation, which is one of the goals of the Fed. And there are multiple reasons why high inflation is bad, in case you were wondering. And I'll send a link shortly about why on an article of why that is. But just think of it as contractionary monetary policy as just mainly a way to combat high inflation.
So how do banks and the Federal Reserve make money? Obviously, you can't have a bank that doesn't make money, like through loans or through whatever other efforts, but you can utilize interest rates, which is the cost of borrowing money, and obviously they use these interest rates to make money off of their customers. So there are two different types of interest rates we're going to talk about today. One is the discount rate, which is how much the Federal Reserve costs, how much they charge to their member banks to loan out their money. Does anybody know why the Federal Reserve would loan money to the bank? Like, let's just say Chase needs to borrow however much money from the Federal Reserve. Why would to loan the money instead of outright just trading that money for securities?
Because the money is more beneficial. They can, the bank can give it out as, say like you earlier you were talking about people being able to withdraw money and the bank not having money, so that can be used in that case, and securities won't be a favorable option because no one would want securities when they want actual cash.
Yeah, so basically, like Guion was on the right track, but essentially, in order to meet that 10% minimum that the government requires all banks to have, they always have to have at least 10% of all of their money on hand, ready to give out anytime their customers want to withdraw it. In order to make that 10%, which of course banks don't want to have that reserve kept, because banks make money off loans. Obviously, they want to loan as much money out as possible. But in order to meet that 10%, they borrow money instead of keeping their own money. Because if they borrow their own money, then they're allowed to loan out the rest of their non-reserves. So only the reserves are kept in order to fulfill the needs of the customer. And we're also going to be going through federal funding rates. So essentially, that's the minimum rate required by the Federal Reserve for banks to loan money to each other.
Right. So as I mentioned earlier, one of the ways the Fed pursues an expansionary monetary policy is through lowering reserve requirements. But first, let's define that reserve requirement. So as mentioned earlier, reserve requirements are the amount of cash that banks must have in their vault or at the closest Federal Reserve Bank in line with deposits made by their customers. Reserve requirements are the amount of funds that a bank holds in reserve to ensure that it is able to meet liabilities in case of sudden withdrawals. So think of like how Matt mentioned about those panics. If you've taken APUSH or currently in APUSH, you'll learn that during these panics, there's usually a run on the banks because people want to withdraw their money because they're scared and they want their money on their hands. And what ends up happening is that the banks don't have enough money to cover because everyone's withdrawing, and they fail. So that's why this reserve requirement is there in the first place. The Federal Reserve may actually change their target reserve requirement in an effort to make money more or less available, although it is quite rare. So the reason this works is because if we decrease our reserve requirements, so we decrease the amount of money a bank is required to have with the Federal Reserve, that means that the bank can have more money to loan out, meaning more money will flow in the economy, which leads to economic expansion. On the other hand, if we increase that reserve requirement, let's say the bank is required to have more money with the Federal Reserve instead of having it on hand, there's actually less money in the economy that they're borrowing out, they're leading to economic contraction, which of course fights inflation, as I mentioned earlier. So in the past, usually these are the guidelines set by the Federal Reserve. So banks with total deposits less than 16.9 million have to have 0% of their deposits in reserve. Between 16.9 million and 127.5 million, that turns to 3%. And any bank with deposits over 127.5 million must keep 10% of their total deposits as reserve. But that has obviously changed, as Matt mentioned earlier. So does anyone want to not guess but answer what the current rate is as of 2020 and 2021? Because Matt did mention it, but although very brief.
Take any
I'll give a
guess.
hint. I'll give a hint. It's a lot less than what it was previously. All right, seeing as no one wants to take a crack at it, I'll just say it is 0, because due to COVID, the Federal Reserve wanted to pursue expansionary monetary policy, and as such lowered the reserve requirements to 0 so that there's more money flowing in the economy, and so the economy can grow even more.
Yeah, Matt, I think I'm gonna take over for the screen sharing for this one since I'm recording on my laptop. But thank you for that. Okay. So quantitative easing. So Ronak just now and Gordon talked about 2 of the 3 methods in which the central bank would basically stimulate the economy, right? Or change the economy through interest rates as well as reserve requirements. So the third one is quantitative easing, or QE for short. And it's used when short-term interest rates are already low and the Fed wants them to be even lower. Like right now, right? 0% was what Ronak just mentioned. And it's important to remember in the context of America that America is very obsessed with individualism and the separation of the government and the economy, right? So in America, the government can't tell banks what interest rates to set. And this might seem like normal to you guys if you're aware of it, but in a lot of other countries, they would view that as strange because their government can tell their banks what interest rate to set. In America, that can't happen, so the Fed has to influence them through things like quantitative easing. So QE is a holistic strategy that's intended to lower borrowing rates and thus stimulate the economy. And the main tool that we'll talk about to achieve QE is open market operations. It's basically when the central bank either buys or sells government bonds from the market. Okay, so let's clarify that open market operations can involve buying or selling bonds. But for quantitative easing, this would only be one of the 2. So the question is, if the purpose was to stimulate the economy, thus expansionary policy, will the central bank buy or sell securities? Anyone can unmute or type it in the chat. You have like a 50% chance, so you might as well guess.
I'm not allowed, right?
Dairy's not allowed. Okay, let's clarify the question. So if you think about it, you want the economy to expand, right? You want expansionary policy. If you want to grow the economy, are you going to buy more bonds or sell government bonds? Okay, so the answer would be to buy. It's kind of a long answer, so I'll try to break it down to make it simple. Okay. Let's say I was the Fed. Okay, let's say I was like Jerome Powell or something, okay? And then we say, what if our member banks, right? Like who I would send cash out to. Let's say our member banks are Joshua and Fiona. So Joshua and Fiona are 2 member banks. And what I do is I would actually buy bonds from them. The reason being, when I buy bonds from Fiona and Joshua, I give them cash as a transaction, right? And so now that they have more cash, they can also loan more cash out to regular people, like let's say like Derry or someone, right? And so that would stimulate the economy, right? Because me buying bonds injects more cash means more loans means more growth, more stimulation. Okay. If you are someone who works better with visuals, here's a diagram that will break it down better. I, the central bank, I print money, I buy bonds, and I inject cash into the system. When I inject cash into the system, it lowers interest rates, right? If you think about it this way, different banks that suddenly have more cash on their hands will be competing in order to get customers to loan or to borrow money from them, right? So like if Derry, a regular person just walking by, wanted to loan money or wanted to borrow money, both Fiona and Joshua would be competing to loan him cash. And the way they compete is to lower their interest rates to make themselves more appealing, right? It's the same way that like businesses, like Spotify and Apple Music would like lower premium subscription rates or something to get you to buy them. Same thing with banks. Okay, so when they reduce the interest rate, obviously you want to loan more, right? Because now it's easier to loan. You don't have to pay back as much money. Now that it's easier to loan, more people borrow money, and more people consume in the economy, and the economy grows. Okay, so there's intended and unintended effects in quantitative easing, right? So intended effects, right? Most directly, I am literally injecting cash into the system, right? By buying bonds, so I would increase the money supply. By doing so, I also lower the cost of money, right? Because it's not like I suddenly increased the value that is in the system. I just printed more money. And like we are the ones who put value into the money. So now there's just more like objects or like money objects, cash, that is divided into the same amount of value, right? So the actual cost of money is lowered. And also interest rates are lowered and borrowing increases. As for unintended effects, I think even if you aren't in this club, you would have heard of inflation. So whenever you add more money into the system, you risk inflation because it's not like there's more value in the system. It's just more money, like printed money, chasing the same amount of goods, right? And so if you do the math, right, there's like a lot of money, like printed money out there, chasing the same amount of goods. So each good will be worth more hypothetically, not really, but like the price just soars, right? So this is basically when you go to the grocery store and you see that your eggs are costing like $5 instead of $4, it's because there's inflation. An unintended consequence could be the devaluation of currency. So let's look at China in around 2018 to explain this phenomenon. So what China did was they basically purposely devalued their own currency. You might wonder, like, why would they do that? Why would they want the yuan to be less valuable, right? The reason being that it's more appealing to foreign investors and foreign consumers, right? Because now it's easier to get a hold on like basic goods. And so this makes exports more appealing and more people buy exports and less people buy their own country's imports. And if you know anything about Trump, or President Trump, sorry, you know anything about our President Trump, you'll know that he was involved in the US-China trade war for those reasons. He was angered about the export-import deficiency, right? The fact that China exported so much to the US compared to what we did to them. Okay, so we're going to do a short case study on the 2008 financial housing crisis because it is such a multi-layered crisis. We will be going into it in our own presentation like a little later. But for today, we'll just like skim the surface and try to understand the basics. But before we actually get into how quantitative easing relates to that, we have to know what the problem originally was, right? Because quantitative easing is the solution. So the problem, basically, it boils down to a lot of people taking risk, the risk not working out, and a lot of people suffering because of that. And it's called a housing crisis because of things called mortgage-backed securities. I think this Khan Academy video honestly explains it better than I do, so I will play it. Someone let me know if you guys can hear it or not.
Let's say I'm some type of an investment bank and I go out there and I buy a whole bunch of mortgages. So right here are a whole bunch of people's mortgages. And when I say buy a mortgage, it means that the homeowners who borrowed the money, instead of the money going to the mortgage broker who the homeowner thinks that they got the loan from, or from the servicer who they think they're paying the check to, since I now have bought these mortgages, I've essentially become the lender to the homeowner, and so the homeowner's mortgage payments will now come to me, the investment bank. it will now come to me, the investment bank. So I do this for a bunch of homeowners right over there. But I don't want to be the end holder of the paper. I really want to be an intermediary. So what I do is I set up a special purpose entity. I set up a special purpose entity, which is really just a corporation that I set up, and I stick all of the mortgages inside of that special purpose entity. So I stick them all inside of that. So now the special purpose entity is the owner of the mortgages, and the investment bank, at least starting off, would own all of the shares of the special purpose entity. And so the investment bank could then sell shares. It could split the special purpose entity into 1 million or 10 million shares and then sell those shares to investors. It would sell those shares to investors. And these shares would be called mortgage-backed securities, or sometimes MBSs. They're a part of a general class called asset-backed securities. Because what's going to happen now is that all of this money flowing from homeowners will go to the mortgages, which are now owned by the special purpose entities. So they'll all end up inside of the special purpose entities. And some of them will default, some of them won't. But on average, the special purpose entity will then be able to pay a dividend, or essentially, you can almost view it on interest on to the owner of the mortgage-backed security. Let's say I'm some type of an investor.
Okay. So to break it down really simply, right, we have a lot of people buying into the real estate market, and banks basically throwing money at them, throwing loans at them. They don't really care how reliable you are. They're just throwing money in your hands because they don't want to hold on to money, right? When you hold on to money, right, when you keep money under your rug, it doesn't grow. It actually gets less valuable over time because of inflation. On average, we experience inflation. Okay, so when the banks take excessive risk by loaning out to unreliable people, what they do is they don't just take on the risk themselves, right? They created those SPEs and basically passed the risk on to investors, right? People who basically bought them as stocks, and they were being paid dividends, except they weren't when people defaulted because they couldn't pay their loans. So you see this, like, basically this catastrophe that influenced a lot of people, mostly middle-class people, and it definitely reached a lot of different people's wallets. And as a result, you see banks failed, unemployment soared, stock market crashed, and international trade declined, right? The usual crisis things. Okay, but if you look at the numbers, right, remember the federal funds rate and the discount rate were two things that I think either Ronak or Gordon brought up. And what's important to note is they reached 0, which is really, really concerning, because that means that the Fed doesn't really have much choice on what course of action they then want to take, which is why they're basically forced into doing QE. So QE is when the Fed buys bonds, right? So in this case, they bought bank debt, US Treasury notes, and MBS. And they did this in 3 or 4, depending on who you ask, phases of QE from 2008 to 2014. And they finally ended the program in 2014 because the economy was finally growing again, so they didn't have to do it. So the question is, of course, did it work? Almost everyone will say yes, QE did work very well. It basically removed subprime MBS from the balance sheets of banks. There's a really long way of saying they bailed out banks, right? Just like in the Great Depression. They bailed them out, they stabilized the economy, they stabilized consumer confidence, they also kept interest rates low, and they stimulated the economy. So a lot of really good things. But I think equally important to mention is that they did not cause rapid inflation, which is something that a lot of critics were worried about, but it didn't happen, so that's good. Okay, here's a quick question. I really don't expect anyone to know this, maybe not even Matt, but what country used QE first? Officers, you can guess too if you want. Well, that was no fun, Gavin. Yes, it was Japan. Anyway, it was Japan in 2001 to 2006. I don't really know much about the instance. That was just the first known example of QE. It also happened in the European Central Bank in 2015. Okay, and finally, let's get to the actual diagram, right? So you see in the diagram, there's 3 shaded portions representing 3/4 of QE, or the 3 phases of QE. And what's important to mention is some economists say 4, some say 3, right? It doesn't really matter. But this is basically representative of all of the steep inclines of the red, right? Reserve balances with Federal Reserve banks, which basically means how much money or how much cash they had on hand because of how much cash the Fed was injecting into the system by buying government bonds. So obviously when I buy government bonds, I'm giving more cash. More cash means a larger balance, which is why there's such an increase in red. Okay, and finally, we're gonna have a crash course to summarize everything we talked about today. Hopefully it sticks in your mind really well. And then after that ends, we will continue on with the second part of our meeting and say goodbye to the seniors that joined us today.
Welcome to Crash Course Economics. I'm Jacob Clifford.
I'm Adrienne Hill, and today we're talking about monetary policy.
So each year, Time Magazine comes out with a list of the world's 100 most influential people.
It includes heads of state, religious leaders, entrepreneurs, artists and activists, singers and actors, the most famous and infamous. There's one person on that list, someone who is arguably the most influential person on earth that most people don't know. Their decisions, good or bad, likely impact billions of people. Janet Yellen.
She steers the largest economy in the world. Janet Yellen is a big deal, and she's a big deal because of monetary policy.
The Federal Reserve is the central bank of the United States, and it's commonly called the Fed. Europe has the European Central Bank, or ECB, and other countries have institutions that play similar roles. Most central banks have 2 important jobs. First, they regulate and oversee the nation's commercial banks by making sure the banks have enough money in their reserve to avoid bank runs. Their second job, and the job we're going to focus on today, is to conduct monetary policy, which is increasing or decreasing the money supply to speed up or slow down the overall economy. Monetary policy is what makes the Fed and the Fed chair so influential.
Let's start with interest rates. An interest rate is the price of borrowing money. When banks lend money, they expect to be repaid the amount they lent, which is called the principal, and a percentage of the principal to cover inflation and to make some profit. That percentage is called the interest rate. The number of car loans, student loans, home loans, and business loans that get made depends on interest rates. When interest rates are low, borrowers will find it easier to pay back loans, so they'll borrow more money and spend more. When interest rates are high, borrowers will borrow less and therefore spend less. In the US, the Fed doesn't have the power to tell banks what interest rate to charge customers. So instead, the Fed manipulates interest rates by changing the money supply. If the Fed increases the money supply, there'll be plenty of money for banks to loan out. Borrowers will shop around for the best deal on a loan, and banks will be forced to lower interest rates because they're gonna have to compete or else no one's gonna borrow from them. A decrease in the money supply has the opposite effect. Less money supply means that banks have less money to loan out, so they're gonna try to get the highest interest rate possible. So less money, higher interest rates. If the central bank wants to speed up the economy, they can increase the money supply, which will decrease interest rates and lead to more borrowing and spending. That's called expansionary monetary policy. If the central bank wants to slow down the economy, they decrease the money supply, less money available will increase interest rates and decrease spending. That's called contractionary monetary policy.
Here are some real-life examples. After the dot-com bust and then 9/11, the U.S. economy was in a slump or a recessionary gap. Output was low and unemployment was high. To speed up the economy, the Fed boosted the money supply, which lowered interest rates. This made borrowing easier, which increased spending, and as a result, the economy began growing again, albeit slowly. Here's another example. In the late 1970s, prices were rising up to 13% per year. Inflation is usually more like 2 to 4%. The Fed chairman, Paul Volcker, decreased the money supply, causing interest rates to shoot up. People bought fewer homes and cars, and businesses invested less. Contractionary monetary policy drove down inflation, but with the downside of increasing unemployment. There are just no easy answers here. Sorry. During the Great Depression, though, the Fed blew it. 73 years later, Fed Chairman Ben Bernanke admitted, "We did it. We're very sorry. We won't do it again." So what did the Fed do wrong? Well, there are 2 things that keep the banking system healthy: confidence and liquidity. When customers deposit money in a bank, they need to feel confident they're going to get their money back. In the early years of the Great Depression, the Fed allowed several large banks to fail, which caused widespread panic.